I'm Howie Lim. This is Money Hacks by the Business Times. As the Year of the Horse Hoofs interview, the world of fixed income isn't as fixed as it used to be. After a turbulent 2 years, interest rates are finding their footing, but the quest for reliable, high-quality yield remains a formidable challenge. Are SSBs a relic of the past? Is corporate credit a ticking time bomb or a golden opportunity? And what's the one thing most retail bond investors get fundamentally wrong? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And joining us today to navigate these choppy but opportunity-rich waters is Goh Rong Ren, Portfolio Manager, Fixed Income, Eastspring Investments. Rong Ren, thanks for your time.
Hi, Howie. Thanks for inviting me over for your podcast.
Very quickly, though, I wanted to ask if people had a difference when it comes to, say, the beginning of the year or the beginning of the lunar year. Should there be when it comes to, say, adjusting their portfolios?
It's to do with how people tally their returns for the year and decide whether they want to protect the returns they've enjoyed over the course of the previous year. Well, I mean, if you are the superstitious sort, the new Lunar New Year brings about some feng shui related changes as well. In a feng shui type of evaluation, they might say that this is a good year for you to invest, or this might not be. This could influence how they actually reallocate or invest. But of course, that's not how we actually approach our investments.
And also, I think most people, it's a keep calm, stay invested type of motto. Let's just think about, coming from a reset perspective, what the critical risks retail fixed income investors should be thinking about.
Yeah. When we decide on our investment objectives for the year, as well as how we want to position ourselves, fundamental analysis forms a core part of it. Assessment of the fundamental risk would be an important consideration. First one, of course, is inflation. We know that post-COVID, because of fiscal expansion and spending by governments to support COVID-related disruptions, resulted in very high inflationary pressures. Inflation has started to moderate over the last couple of years, fortunately, but it doesn't actually fall in a straight line. Some may argue inflation may have actually plateaued. So with inflation trajectory actually uncertain, this translates into yields becoming more volatile. It used to be over the last couple of years, yields have gradually declined, but we've reached a point where yields have come off quite meaningfully. Over the next few years, I don't think we are going to enjoy the kind of gradual decline we've experienced. So this actually advocates more caution for fixed income investments. The second one relates to economic growth. We had monetary policy tightening, which is followed by monetary policy loosening, which means central banks have been cutting rates. We have now reached the end of the cutting cycle simply because economic growth has moderated. The trillion-dollar question, if you like, amongst policymakers is whether growth is going to continue declining to mark the end of a market cycle, or are we going to see some steady state here where growth slows but still remains benign in terms of the conditions. Economic growth is something that we watch very closely. A lot of forecasts since 2 years ago have been forecasting some sort of recession, but this has not materialized because of AI and tech-related spending. This has supported growth in the US, and to a large extent because Asia is export-oriented, this has translated to some tailwinds for us as well. The health of the global economy is actually closely tied to this AI capex boom that we are actually experiencing right now. So certainly this is an area that bears watching in terms of how the market sentiment towards this important segment evolves over the next 12 months. I mean, it currently is an opportunity, but it could very well turn into a risk from a fixed income perspective.
You've said many things that are very confusing to people, Rong Ren. First of all, interest rates are stabilizing, are they not? So it should be getting better. Also, this investment into AI tech capex, there are many who are now getting a bit antsy because they're not seeing an ROI on that. What should fixed income retail investors do if they want to look for, say, genuine yield?
That's a very fair question. What this means for fixed income investments is, number one, if inflation becomes a risk, which means higher inflation rather than lower inflation, then some of the duration gains enjoyed in the past 2 years may not be as straightforward. Investors will need to focus on carry returns and not from yields actually dropping. Because when yields drop, then you enjoy gains on your fixed income portfolio. Number two, economic growth has been very healthy over the last 2 years, partly because of the moderating monetary policy. That means rates are coming lower, as well as the AI capex boom I mentioned. So this has introduced liquidity into the market. There is a lot of money actually chasing yield. This has led to what we call credit spread compression. People are buying corporate bonds over government bonds because they think that they want the additional yield over the risk-free government return. Taken together, this has resulted in additional gains for investors who went in early. We are currently at a cycle where credit spreads have compressed to the level where it has become relatively rich. Investors who are looking to invest now compared to, let's say, 2 years ago should be more cautious. So on an overall basis, if you are a fixed income investor, you should be slightly more cautious than you were 2 years ago. But that's not to say you shouldn't stay invested, because not being invested means that there is a opportunity cost. What you should instead do is to weigh the opportunity cost of not being invested versus the kind of risk that you are taking on to get that additional yield on your fixed income portfolio.
Is there a difference then, say if you were younger or if you were older, fundamentally, when you're constructing your fixed income portfolio?
Yeah, a younger investor, you can treat a bond as a portfolio stabilizer, if you like. As you focus more on growth assets, it can be your equities, but it should still remain, a part of your portfolio, because that's the whole point about fixed income investments. It generates income for you in the background, which you can actually reinvest into more risky assets, if you like, for higher growth potential. For someone in their 50s, you're talking about someone who is preparing for retirement. Then you start using the bonds to build reliable income and also to reduce a portfolio swing, because you can't afford it as much as someone in his 30s. So bonds, they shift from being optional when you're in 30s to something that is essential when your retirement actually approaches.
Earlier, you said there's a move toward people wanting more corporate bonds versus government bonds. So then how is the SSB or Singapore Savings Bond still relevant now as a fixed income strategy, or are those more liquid alternatives more attractive and will continue to be more attractive this year?
Yeah, I think Singapore saving bonds essentially are Singapore government bonds. You are buying the AAA rating of the Singapore government. In the scheme of bonds, this is probably as safe as it gets, highest rated in the world. And they will always remain useful because they are safe, they are flexible. Flexible meaning that you can buy, you can sell without an issue, serves your liquidity needs. You don't have to pay through a nose to withdraw, sell. But what we have observed in the last couple of years is that yields have started to decline as the rates have fallen. What you previously could enjoy on this risk-free rate is no longer the case now. And it might be a little too low for some investors, may not actually necessarily meet the long-term retirement needs. So with that in mind, you should not rely on SSBs alone. You should combine them with a diversified bond fund to improve your income while you keep your risk manageable. SSBs, they are a good foundation, but they are not the whole house. They should actually be just one part of your entire portfolio as you look to build income in a reasonable manner.
Still to come, why so popular? By virtue of its name, fixed income doesn't sound too exciting, but we Singaporeans love them. Let's have Goh Rong Ren from Eastspring tell us how to manage risk and returns in this space moving forward. Stay with us.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
What about the other misunderstood things about fixed income investing that you've discovered over time? Beyond duration, the things that might cost retail investors returns because they don't understand completely how it all works.
Yes, you're absolutely right. In fact, this is something I realized in the course of my extensive conversations with some retail investors. Number one, many investors actually think that bonds are risk-free, but they are actually not. And price volatility still matters to them. When they buy into the bond fund and they see that it's down 2%, they start getting worried because they have the impression that bond funds are like cash and they should increase incrementally. So they often, as they chase yield, they are not maybe as well informed about what kind of risk they are taking on when they actually look for higher incremental income. For example, if you buy long dated duration bonds at the wrong time, or you chase high yield without understanding credit risk, this will actually hurt returns more than they expect. When the Fed as well as central banks around the world started hiking rates, a lot of investors wondered why did this actually result in price pressures on their bond funds. It's because of duration pressures on the fund. But it is momentary, it's transitory because this relates to how bonds are actually priced. But still, it creates unnecessary fear amongst investors simply because they do not understand what exactly is going on their portfolios. Bonds are actually safer than stocks. There's no doubt about that. But they are not risk-free. So they have to appreciate that with additional income they seek, they are taking on different types of risks like duration risk as well as credit risk. Understanding what you risk will give you more comfort in actually holding on that risk through the cycle to realize the original intended income gains and expected gains.
So then if you're looking for yield but you're afraid of risk, should then high yield or junk bonds play any role in your portfolio?
Yeah, so I feel a need to address the terminology here. Junk bonds convey an impression of very risky bonds. When I mention the word junk bonds to anyone, they get the impression that these bonds are essentially worthless or can become worthless. But this cannot be further from the truth. In fact, I'll argue that, the line drawn between investment grade and high yield is one that is just there for the sake of demarcating two different segments of the bonds. But in between the lowest rungs of investment grade versus the highest rungs of high yield, there is actually very little difference. In terms of the credit risk spectrum, it's a gradual move down. It's not a big binary step down between IG and high yield. So we shouldn't just brush off high yield in one broad swath and focus purely on IG because there are high yield issuers who are on the brink of breaking into IG. Do you ignore them simply because they are high yield? I think it presents an opportunity for investors because when you buy into it just before it gets upgraded, then you can enjoy some price gains as well as better yields before this happens. Which brings me to a point about the need for active management of a bond portfolio. What we try to do is to find opportunities for investors on their behalf within these portfolios on an active basis. Retail investors might not have the time, may not have the expertise to go into the granular issuer level type of evaluation. I mean, this is our bread and butter, and we find these opportunities on their behalf. This is particularly important as you scale down the risk curve, you scale down the credit curve. High yield becomes an important part of the toolkit to enhance income on a fixed income portfolio. But we do not think that it will form the largest part of the portfolio. At the end of the day, we believe in balance. High yield works as seasoning. It's not the main dish. The main dish would still be, the investment grade bonds that underpin the stable income that you can actually generate.
A lot of people have been talking about the fall of the US dollar and what's happening with it, the questioning of US exceptionalism as well. Do you have an outlook for the US dollar Singapore dollar exchange rates and how that might affect things for retail investors, in particular, say, Singapore denominated bonds or returns?
So, okay, the strength of the dollar is very much driven by its absolute yield. Prior to the last couple of years, post-COVID, the Fed was hiking rates from 0% all the way to 5%. This underpinned the strength of the dollar because many investors saw it as a compelling carry trade. You put your money in dollars, you earn 5%. It's the gift that never stops giving. The dollar becomes stronger. But now, if the US rates were to eventually fall, especially with the Fed in the middle of a rate cutting cycle, there was a bit of a stall in 2025 because of tariff concerns from the Fed, inducing inflation, etc. But it appears that they are embarking on the rate cutting cycle again. This could actually reduce the returns for dollar investors, which would in turn look to actually allocate out of the dollar fixed income assets. With the dollar potentially weakening on the back of lower dollar rates, Sing investors holding dollar bonds could see some pressures on their dollar denominated investments. This is something that is worth watching or worth thinking about for Sing-based investors. Maybe if you have a pure dollar denominated exposure in a fund or investments, you can look to hedge it by actually going to a sync hedge class, or you could actually think about maybe rotating out of the dollar exposures partly into non-dollar exposures. It could be sync denominated investments, or it could very well be multi-currency strategy, for example, or a local currency bond fund, which will actually immunize your portfolio against dollar weakening, which could very well be a structural trend in the next few years.
Rong Ren, give it to me straight. How? Who? What? How should we, if we're looking for income in particular, do up the portfolio? Do we prioritize unit trusts, ETFs, Asian bonds?
I just have this to say. When it comes to bonds, buying individual bonds sounds appealing because I cut out the middleman, I don't pay fees, and therefore I save money, and this is the most efficient way. But diversification is difficult, especially if you do not have large capital. In sync denominated terms, the minimum bond size is like 250,000. In dollars is US 200,000. So funds and ETFs actually give you instant diversification. You get professional management, which I believe actually suits retail investors better. A soundbite, if you like, is that, one bond is a bet, but a fund is a portfolio. And what retail investors should go for is actually a portfolio.
Sounds good, Rong Ren. I wish we had more time. Thank you for your insights today.
Thank you very much, Howie. Thanks for having me here.
Goh Rong Ren, Portfolio Manager, Fixed Income, Eastspring Investments. I'm Howie Lim. This has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.